Very good morning, everyone. Welcome to Admiral Markets. Thanks for joining us this morning. And we're going to take a look at strategy is the main topic for today. And I think we have some interesting stuff to take a look at. But before we do that, we're going to explain this PowerPoint first of all. First thing that you should note is that this webinar is intended for a global audience. It may not be suitable for everyone. To find out if it is, please visit admiralmarketsglobal.com, select your country residence, and contact the appropriate entity also to find out more about the conditions and other details. Also, please note that Forex Exchange and other financial markets is considered, trading those are considered high risk and may not be suitable for all investors and traders. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with the disclaimer mentioned here. You can always request a copy of the disclaimer by taking the same route as I mentioned, admiralmarketsglobal.com. So today's focus, strategy, is always very exciting. I think strategy is what many traders like to look at. Maybe best actually to say that entry strategy is the most popular, to be very specific. And that's, of course, where a lot of our focus and attention is geared towards. And that, in a way, is logical, but we have to be careful that A, we don't only focus on that, and B, that we don't, let's say, make a perpetual mistake of always trying to find the next best thing and try to keep wandering around for something that is almost perfect. That are the two common things that you see as like weaknesses with traders. And yeah, the best, of course, eventually we have to find great entries and look at the charts in a new way and to discover new things. But eventually we have to settle down and actually be kind of happy with the routine day in, day out, because without a routine, we are going to be always shopping around for another good thing, another great thing that's maybe better than what we're using now. We need a routine really to implement our trading plan day in, day out without getting distracted. So strategy, basically, once you have a trading plan like that, it becomes, of course, a bit more of a habit already. And ironically, it's the habit, in fact, that is part of the success, because if you look at, for instance, anyone who's successful in any field, they are making a habit out of it. Let's give, for example, let's make an example. Let's say, you try something new and you do it for 8 weeks. If you do anything for 8 weeks, let's say, then you're going to bump into the situation that if you stop after 8 weeks, the skill that you've learned slowly fades away. Look at language, for instance. So only a habit or routine and doing something repetitively at a fixed rate will will increase your experience and actually keep that experience. Otherwise, you're slowly going to fade away, right? So that's what we have to do with trading too. It cannot be something we do for 1 week, then set aside for 5 weeks and come back after 1 week, right? Well, anyhow, now I'm getting a bit into a different topic, but that was my point. Or points, perhaps. Let's say, take a look at the Forex calendar, and we have a big news event, FOMC statement, and we probably saw some dollar longs being closed yesterday because it was a very aggressive move up. And well, we did have, of course, a pretty far trend on the dollar, so some profit grabbing actually makes some sense, of course, if you think about it, because tonight the FOMC is going to discuss how far they think the U.S. is in their progress. Now, the question is probably not going to be, will there be an interest rate increase or not? I don't think it's way too soon for that. So I don't think that would be the question at all. But what we can look probably at the text, what they release, and try to find indications how patient the Fed and FOMC will be with regard to interest rate hikes. Are they going to change their tone and emphasize the patience and emphasize that they will be very cautious with increasing it? That could be dollar bearish, because then interest rate hikes are further down the road than probably the market expects at this moment? Or are they going to keep the same path, keep on the same track, and say about the same as they did last time? That would probably be dollar bullish, and we see the euro dollar fall in that case. So I think that's probably the main question for today. I don't expect anything else. It's just a question of how much patience can we read between the lines, or can we read on the lines when looking at that statement. Is it extra cautious or just normal cautious? The next statement is apparently in March, so it's going to be taking some time after that. I therefore definitely don't expect an interest rate hike today. It's too soon. Quantitative easing part 3 was just completed. They need to see the effects, first of all, of that completion. That itself already was a step, a big step. So that itself, the effect of that is going to have it's going to have, of course, a major impact, and they want to see how the economy responds to that. All right. Then we have, of course, another reason why I don't think we're going to have interest rate hikes is that the ECB just implemented the quantitative easing of its own. The Canadian dollar, the CAD, the Bank of Canada, reduced the rate from 1 to 0.75. The Bank of England bank rate votes went down from a split 7-2 to 9-0 in favor of keeping the rates the same. So there, too, no increase likely. Probably no decrease either, but it was actually probably, if anything, hinting at a potential hike. So that's out of the question for the moment. So I don't think, looking at these central bank developments, the U.S., I don't think is going to start a trend against that. It hasn't risen rates since 2006. I don't think it will do that this year either, considering these central bank developments. Then we have its own data. The data itself is showing definitely some good stuff once in a while, but it also is quite a mixed bag, and has been for quite a while. And although there is a recovery, the recovery is modest, and I don't think they want to endanger that. The only thing that's really rocking and rolling is the stock market, and the stock market itself has actually hit, if you look at the total market cap versus the GDP, it's actually hit in a pretty crucial level. We're looking at a 122% level. Now, if you look at the 2008 levels, when you look at the total market cap versus US GDP, it was around 100, 110, I think. It's above 2008 levels. That is suggesting a potential, a moment that we could be near a market turnaround on the US stock market. It is getting quite overstretched, but it doesn't have to necessarily stop here right now. It could still push forward. Why? Because if you look at the dot-com era, actually the market cap reached 150% of the GDP. So there is potentially, that was the very high point. We are at historical highs with 122%, but not necessarily at the highest point. So yes, maybe some more upside, but we are getting closer to a level where the stock market itself is getting a bit overextended, to say the least. But it doesn't have to mean that the turning spot is now here, tomorrow, next week. So I think that also the global recovery, if you look, of course, at that particular stance, it doesn't really look that great. I don't think the Fed is going to make that decision this year. So especially considering the developments of the last few months, I don't think that this seems likely. So we're probably going to have a 2015 at this moment. That was the main question, of course. At the beginning, at the end of last year, do we get interest rate hikes? Do we get the ECB quantitative easing? I thought the quantitative easing was 50-50 for the euro. For the ECB, I thought the interest rate hikes were probably less likely than the quantitative easing. But with the current developments, I think it's definitely unlikely at the moment. Of course, a year is long, but I would say very low chance, at least in the first 6 months. But that's just my estimate, of course. I could be dead wrong. But considering these, as I said, these points, I don't think that is very likely. So anyhow, sorry for that bit of longer discussion there. Hope you don't mind. Let's first of all, a question from Lakshman. No, unfortunately not able to look at that. Unfortunately can't see the dollar indeed against the Indian rupee. No, unfortunately not. That's a pity. Katie is asking, can you suggest a place to read or how to improve the fundamental knowledge? Well, let's see. I write sometimes a blog on that, first of all, but second of all, I guess standard news sources I use. I mean, I don't have any particular spot that you would not know of or something like that. I just read most of the things at CNBC really. So fundamentals, definitely the last few years. I mean, the fundamentals are always, of course, in the long term important, but they have been quite visible the last few years and the last few months. Maybe more so than in the past, but difficult to say. Well, anyhow, let me know if you disagree or agree, perhaps. In the meantime, this is the euro-dollar chart. And of course, the FOMC statement is going to be interesting to see how technically the euro-dollar month ends. Is there going to be a big wick here? Or is there going to be a strong close? Strong close, of course, definitely bearish. A big wick, I would say it could be caution. I wouldn't say it's a necessarily uptrend after that because the momentum down was too big. So that will remain an interesting question. Let's take a look at the weekly chart. You see a very strong candle, in fact. So if anything, from a weekly perspective, we're in shorting territory. Because if we put a fib on this bearish candle, we can see, as I said yesterday, that we're getting into the 50 fib area, and that is, or 38.2 I thought was really interesting, and the 50 I thought both were interesting zones. Now, will price turn here? We really have no guarantee of anything. Nothing is a shoe-in, nothing is certain, but it looks like the odds are in our favor. The probability seems pretty decent. Now, considering the news event, though, that's a bit of a tricky element. How do you incorporate a news event like that? You could do two tactics. You could just wait and sit on the sidelines until the news event happens and then react to that, or stake out a position and, of course, then hope that the statement kind of goes into your way. So those are the two options. If you do stake out a position, then I would choose for a wider stop loss, because then even a spike against one yourself could still be survivable. Plus, anyhow, basing a risk on a tight stop loss probably is not the best thing in front of a maybe volatile event. Maybe not volatile. I don't know. Doesn't have to be a big movement today, but could be. So I think the wider stop loss above the top here is better. Of course, the lot size is therefore bigger, but if one reduces the risk taken to incorporate the big lot size, of course, let's say we take whatever risk you're used to on this side, on this trade, and you just take a lower lot size. And that's why you can still risk a normal risk percentage, of course. Other thing that I think was interesting today regarding strategy specifically, how many of you have a pin bar strategy? Does anyone use a pin bar strategy? That's my question for you. Do you know what a pin bar is, first of all? I got one no. Anyone else? Does anyone use it? Okay. Let's see. We got two no's, one yes, one answer saying occasionally, but more as an idea, And one answer saying not as a strategy, but using price action. Okay, cool. So, of course, the pin bar itself is basically, let's quickly talk about pin bar. Basically, it's a candle where there's a big wick. All right, so we basically see a majority of the candle composed of a wick, like in this odd CAD, Australian dollar versus Canadian dollar here on the weekly chart. This itself is a pin bar. Now, where you set the cutoff could be up for debate. You know, where is how much of wick and how does the candle exactly look like before you consider it a pin bar or not? You know, it's maybe not so relevant. Maybe yes, I don't know, but that is still a considerable discussion, perhaps. But in my opinion, the wick should be at least two-thirds of the wick. All right. A pin bar really, in fact, is anything what you think a pin bar is. I mean, it doesn't really matter in that regard. But if you want to use it now regarding the strategy side of things, I have specific things I look for in pin bars. Oh, sorry about that. Somehow the chart froze. Thanks, Richard. So the pin bar, first of all, is something like this. Right? That should be, I think, now clear that it's basically a majority of the candles a wick. If a bullish example could be, let's see if we find anything here. These could be pin bars, for instance. We got a wick at the bottom, for instance, here. It's anywhere where price kind of makes an extreme, keeps pushing in the momentum, and then there's, let's say we're pushing up and up and up, and then there's an exhaustion at the very end, basically. Now, how to use it in the strategy, because of course we actually could probably find a lot of pin bars, but how would we want to use it in the strategy? That's the next question. And for strategy purposes, I look for certain characteristics of pin bars. I qualify pin bars basically, first of all. So not all pin bars would qualify. The things I'm looking for is two-thirds of the candle should be wick. That's point one. The second thing is that I'm looking for close in the opposite direction. So if we have a bullish run up, I want the pin bar to close bearish. If we have a bearish run down, I want the pin bar to close bullish. The third thing I look for is that the candle close is within the candle body of the previous candle. So, for instance, this pin bar right here, that pin bar has a close that is inside the previous candle. Do you see that? You see the candle close in the candle body there? That qualifies. It's not a must though. I mean, if it's very close, you know, it's more of a guideline than a fixed rule. The size of the wick is a must. The candle close, the bearishness is yeah, I think very important. Maybe not 100% must, but very important. If it's a doji, by the way, it still also would be okay if it's equal to each other. The candle close within the other candle is more of a guideline. Here, for instance, we don't have it. To give you an example of where we don't have it. Still, of course, you get still the upside. So it's not something that it must, but here you have actually only one of the three things I talked about so far in this case. You have about two-thirds of that candle is a wick. The rest don't qualify. You don't have a close in the previous body, candle body, and you don't have a bullish close. But this blue arrow does, you see? Bullish candle, although just barely. The close is within the body of the previous candle. And you have 2/3 of that candle's wick. So this is, I'm just giving you kind of tools how you can assess which pin bars are better than others. And then we can make the judgments if it's worth trading. The fourth thing I look for is, has there been an overextension? Excuse me, has there been an overextension? So what I want to see is a good run up or a run down. A pin bar that is in the middle of a range is in that regard less useful. For instance, here, that is perhaps a pin bar. If you look, if you only would take the criteria that the wick is 2/3 of the candle, it wouldn't be enough, because then this would be a pin bar. This is not an exhaustion of one side. Pin bars are specifically more reversals, right? This is not a pin bar. Why? Because we're having a run down, and then we have a bearish candle. We need the pin bar to be bullish here in this case for a pin bar. So what we need to see is a run up and then a bearish pin bar. We need to see a run down and then a bullish pin bar. If we see a run down and then a bearish pin bar, that defeats the purpose. Do we have a run up? Well, we do. We have 1, 2, 3 candles. And then we have the pin bar. It's okay-ish. I'd rather see more, because then the overextension and the exhaustion the chances of that are higher. Preferably maybe more than 5 candles. The more the better, obviously. If we see 8 or more, that's perfect. 5 or more is already good, I think. Less than 5 is so-so-ish. Because if you get less than 5, then the run up or run down is maybe not that extended as yet, or the chances of that being extended are less. So those are my 4 main points. Any questions on those by any chance? I mean, do they make sense? So then we can qualify with these 4 points each and every pin bar and judge whether it's tradable. Now, if you look at those 4 points and you see a pin bar and you think it is tradable, realize that it's a reversal setup, right? So what we're looking for is how do we tackle the entry and exit? The entry and exit, first of all, the entry then. The entry could be exactly actually right at the candle close. Very simple, very straightforward. The trigger is the entry at that point. The other option, 2 options in fact, is the break of the candle low. The advantage, there are always disadvantages and advantages. Let me explain. The third option is the retracement of the wick. So 3 options. Candle close immediately, market order. A pending order at the break of the candle low, or a retracement of the candle wick and a pending order perhaps at the retracement of the candle wick, or of course, doesn't have to be a pending order, it could also be a market order, and you just follow and look at the charts live when the market makes the retracement, and then make the judgment if you want to trade it or not. The advantages and disadvantages of all those 3. The advantage of waiting for the break of the low is that you're getting kind of a confirmation the price is out of its slump. So sometimes you see, or not out of a slump, but it's out of its momentum. Sometimes you see momentum like this and it keeps pushing. It would never break the low. So you wouldn't even take the trade if it keeps pushing. Right? So you avoid those losses. Disadvantage of the candle low is that you're having a bigger risk in terms of a lot size. And because we're in a reversal, you also your profit potential is a lot smaller. The advantage of a retracement is that the reward to risk potential here is a lot better. Disadvantage is that you might miss the entry because the retracement doesn't go as deep as you think it would. I think a best entry is fibbing the candle and looking for the 50 probably. 50 or 61.8. But any of the fibs really could do. Here, of course, you got a better reward to risk. The target could be the minus 272 target if you take the fib. It couldn't be the target if you take the break of the low. The other target could be the minus 618. You can also aim for moving average. If we add a moving average, because we're looking for a reversal to the mean, in most cases, you could aim for the 34, for instance, but we see in this case actually the 34 HIME is above us, which is a good signal in the sense that actually we're retracing back to the average. So if we fall, we're kind of breaking with the trend in a way. In that regard, we can maybe look at other time frames to see, is there any other moving average that could make sense, but we don't really see that. So we could target maybe the closest bottom, which is actually lower than the fib. All right, so the target is either a support level, it's a moving average, it could be, it depends also how you judge the bigger picture. Is it really a reversal trade? Then you're probably better at aiming a target close by. Or is it actually a setup where you're trading an immediate reversal, but in the bigger picture it's actually a continuation of the trend? Then you might want to be more aggressive with your targeting. So let's take a look at this practical example of AutoCAD. We're looking at AutoCAD, basically, first of all, very zoomed in, which has a substantial wick. This is definitely 67%. You can calculate the difference here, and it's a 309 pip candle, and the close is about 64 pips off. So if we divide 64 by 308, we see 20%. So, or actually, let's take the open. So, sorry, let's see. 1 second. Yeah, 25% wick, 75% wick here in this case. So easily 2/3. We see a candle close within the body of the previous candle. We see a bearish close, and we see three candles or four candles, four candles up before we get the reversal candle. That's the only thing in this case that doesn't match my ideal requirements, right? But then again, it is a weekly chart, so I would be a bit more forgiving of the fact that it isn't 5 or 6 because it is a pretty big time frame. Same would be for the monthly chart. So I do think it's a good pin bar. I would for my strategy, would consider this a tradable pin bar, and that's why I took a short at the 61.8 fib this morning. I put the fib on here and took the entry at 99.64. And I'm up a few pips at the moment. I took it right at the top here, or maybe 99.62, but really right at the turning spot. I was up already 45. So I put the stop loss above the candle high, and I'm aiming for the minus 618 target. The reward to risk is about, I got about a 123 risk and about a 360, so it's about a 360 target, so I've got about 3-to-1 reward to risk on this trade. Based on basically the pin bar itself, that's all. There's really nothing else considered in this setup. I mean, we can look at the market structure, of course, we can look at the bigger time frames and look at trend lines, and we can look at highs and lows, and we can look at moving averages, and we can look at fibs, and we can look at bounces, and anything we want to. But this particular trade was solely based on these elements I just talked about, the pin bar. We can, of course, find confluence. We could probably find things that are not good about this trade as well. Things that support the trade, we got pretty good resistance close by. This was support that broke, for instance. I mean, there are many things we could probably think about. Things that are not good, perhaps, about it is the fact that this was a pretty good momentum, right? I mean, my point is you can find anything. But the idea here is that the pin bar is actually, if you look at the 4-hour chart, we see kind of momentum here. So the idea of the trade would be a continuation of that correction for a zigzag. So that's basically my story. That's what I wanted to show you. Does that make? What do you think about the trade? Do you think it's? I mean, do you see the? Do you think it's something for you? Would you? Is this something interesting for yourself? First of all, maybe I'm not sure. I don't want to ask too many questions, otherwise I overload you. Or is the pin bar strategy maybe something that is not matching you, which is perfectly fine as well, by the way. Just more curiosity than a right or wrong answer here. For those that answered yes, do you use anything different by any chance? Maybe we can share your thoughts as well, and if you want to share, of course, with the group. Are these things you look for too, or is it something, do you have other things that you want to see? I think 2 people answered yes. So let's see, Björn is saying makes sense. Justinus says, interesting, but not for me. That's perfectly fine indeed. It's definitely, as you know, not my only strategy. But because I don't think it's not something that really occurs a lot. You can use it easily on the weekly, daily, of course, but also even on the 4-hour, I would say. If used on the 1 hour, I would definitely want stronger confluence arguments, because an hourly pin bar is easily overturned, and the momentum can blast through that hourly. It happens many times. So it's definitely less reliable. But if you have good confluence and you have other supportive things, then that could be still a good trigger. But you got to have that support. Otherwise, it's not good. But the 4-hour, I mean, if you solely use pin bars, you got to use it in higher time frames. And then, of course, still you're subjective, as always, of course, to streaks. But hourly, you need a lot of confluence. I would say it's, as a standalone element, as a standalone tactic, it's good for 4-hour and higher. Let's see, other comments. The weekly candle is bullish. Well, don't forget, to that I would answer that this candle is not closed yet. So for me, basically the candle itself of this week is irrelevant because it's not closed. So because I only look at candle closes, right? I only judge candles on their closed outlook, then I'm not going to incorporate that. Why do I do that? Because basically a candle, when it's open, could do anything still. This candle at the end of the week could turn into a big wick. Any candle could look totally different at one point or another, right? Let's take a look at this candle here. When it was open, this one, when it was open, it was maybe at one point it was looking bullish. Look, because we had a bullish candle here, that one, and then we have a wick on top of it. At one point, there was actually a big candle and a bullish candle above it. But that candle at the end of the week turned bearish, and that bullish candle actually became a wick. So I never interpret open candles because they can end up being totally different. So the fact that this one is bullish is irrelevant for my trading at this point. If the candle were to end up bullish, I might consider that for trade management decisions next week, though. If at the end of the week this is bullish. Does that make sense, Nate? Do you see that point? Edith is using the retracement, the pending orders on the retracement. I personally like the retracement the most too, I forgot to mention. I rather skip the trade than taking the break of the low. I'm not a big fan of the low, but there are traders that do that. So I did want to mention it, but I like the retracement more, or the candle close more. The thing is that you are more you're more vulnerable to a momentum continuation. That's why I analyze these criteria to make sure that I have a decent rate that the pin bars succeed. Basically, taking the break of the low is to avoid pin bars that don't work out. But I rather solve that a bit differently by being more critical on the pin bars I take, if you follow my point. Let's see, Judy is saying, what about the relative strength of the two currencies? I'm not 100% sure what you mean, the relative strength. Well, of course, it's always useful. I mean, if you have access to a program that could show the strength of the Aussie and the strength of the CAD, I would definitely incorporate that if you have access to that. I mean, I don't have an indicator here that would show that, or any platform that would show the relative strength of the Aussie and the CAD. The only thing I'm looking for now is the odd versus the CAD. You could, of course, look at all the Aussies against other pairs and look at all the other CADs against the other pairs, but I don't know, it's time consuming. So, or do you mean it from a fundamental point of view, Judy? I'm trying to search in what direction you're thinking of. Because of course, if we're looking at, by looking at the odd CAD, of course, we're looking at the balance between these two, and we can see that the Aussie was winning terrain, but probably has reached exhaustion when we see this reversal sign. The fact, of course, that the CAD did decrease its interest rate, for instance, right, would be weak, would not be a good signal for the CAD, and you would expect the Aussie to win terrain on that. So from a fundamental point of view, the short could be a bit shaky here. But this is a technical trade. If at this moment I would not take the trade because of that. But it depends on your view on that. The fundamentals could persuade some of you that it's not a good trade, and I understand that. Okay, great, Killian. Yeah, using these extra things, I think, will help you with the understanding of the pin bars and which ones are good. Now, don't mind you that sometimes reversal candles, like this, for instance, here, this one here, it's not a pin bar, but it still is a bearish candle, and it still had a tremendous run up. Look at all these number of candles here. So you don't have to, of course, a pin bar doesn't have to be the only reversal signal. Let's take a look at that run up, actually. I think it's worth taking a look at. We see here candles with wicks on top, but those did not change the trend. You see that? Because we still had bullish closes, didn't we? Now we see here too a candle with here we had a run up. Look at this candle. Where I have the red line there. Wait 1 second. This one. Well, let me do it this way. This one here. Right? With the red arrow on top. That Oh, sorry, folks. My cat is loose. Give me 1 second. They broke into the office, but if they start meowing, I'll kick them out. uh, let's hope they're quiet. Doesn't seem to be so. They definitely want to share their opinion. They're very talkative cats at the moment. This week, I don't know why. But Burmese cats are known to be talkative. Which is fun. They give nice comments on my charts. So, we're talking about, if it's, I hope they stop. We're talking about this candle here. If we're looking at the basically wick, pretty good wick, but the candle closed outside of the previous candle plus a bullish candle, and we get some follow through. This candle with the green arrow on top, right, that is basically not a big wick, but a bearish close, and actually the reversal signal, right? Okay, 1 second, folks. I'll try to make the room clear here. 1 second. Okay, folks, I'm back. Let's see. Yeah, so the wick here, it's maybe not a pin bar, this one I was talking about, but it was the reversal signal. Here too we had engulfing twins that led to a reversal. But mind you that there are also a lot of signals that don't lead to a reversal. Here, engulfing twins, this is also a reversal signal, but we still get the upside. So, you know, they're not, never ever anything is of course 100% here in trading. So that is that, I think. Let me see where there was some more. You need a big stop loss. Yes, it's about 120 pips in this case, I think, wasn't it? 130 perhaps, 125. Yeah, so if you want to take a 1% risk with 125 pip stop loss, and you take 1 micro as the very smallest, you're risking 1250. So if you want that to be 1%, you would need at least a trading capital of 1250. If you have half of that, if you have, let's say, 600 bucks, you're risking 2% on a micro. So the size of the stop loss, I think, is okay for most accounts. I mean, unless you have a relative small account, then it would be, even with 1 micro, then it would be still a pretty large percentage of your account indeed. But otherwise, it shouldn't be really a problem if you look at the the size. So Nate, my entry basically is at the 61.8 fib. When I fibbed the candle here from high to low, I took the 61.8 at 99.60. I'm not sure what you're referring to, Luxman. I don't remember any post of a training in India. But maybe if you could, No idea. I can check it right now, but that does not ring a bell, unfortunately. Maybe it was someone else who's organizing that or who wrote about that, or I'm not sure, but it doesn't ring a bell for myself at least. So with this pin bar, no problem, by the way. With this technique, we can look and scan the other markets. Now the euro dollar, of course, we already know. We had continuation candles. The pound dollar too. We don't see any signal as yet that we see a turnaround. No pin bar here at all. The Aussie neither. So maybe on the lower time frame, perhaps the 4-hour chart. Let me take a quick look. Not really either. Dollar yen is a consolidation. We have reversal candles within that consolidation. Dollar CAD, let's take a look. Not really a pin bar. In today's market, I don't remember anyone specific at this point. I mean, the euro yen, but it was the very first candle of this week. Right here, the 26th. So most of you, I myself didn't catch that. That was a pin bar. I did have a bullish candle. Well, actually, the wick here is a bit on the small side, actually. So at the moment, I don't see any other pin bars myself. But if you do, let me know. We can take a look at that. But that was the primary idea of looking at the OddCAD, because I saw the OddCAD this morning. I thought it would be good to talk about that in today's strategy session. But besides the OddCAD, as far as I remember, I can't recall any other pin bars. Here's a big wick. It didn't close bullish, but it still was the turning spot. So it depends how much you like that pin bar. Gold, let's take a look. I don't see any pin bar either on gold. Weekly chart still closed bullish. No pin bar there. In general, though, if you look at the market itself, it looks to be at resistance spot. We're at a minus 618 target. We're at a 78.6 fib. We're at a psychological 1300 number. We have a resistance trend line. So it seems to be at a spot that gold might turn here, but for a bit of a retrace. But I mean, any short, I wouldn't be too greedy on the downside, because I think that we could see price rebound back, perhaps 1240. I'll be careful of that. I would aim for a small target. The euro odd, let's take a look. Euro odd. Quite an indecision on the 4-hour chart at least. Best maybe captured by these trend lines. Here we had a pin bar, indeed. And if we put a fib on that pin bar, we had a 38.2 bounce and went up to the minus 618 target. The daily chart had a bit of a wick here. The other requirements were not met, though. 2 of them, right? 2 out of 4. And weekly chart, we don't have it. We had a pin bar here, though, at the turning spot. That was a very nice pin bar, wasn't it? Right here. Only maybe a couple of candles up, but the other things were very nice. So actually, on the daily chart, we saw the same thing here. That was one of the reasons why I actually wrote an article myself on the euro odd reversal. I was targeting a bit more modest target of, I think it was, if I remember correctly, 149 and 147, but it went a lot further than that, actually, all the way down to 140. That was a pin bar. The daily charts, yeah, the pin bars themselves could be different depending on, which chart you look at. I don't think that is, necessarily a problem, by the way. It just does, of course, show that we all have our own viewing point, not only from our psychological point of view, but also just how we see the price on the chart. Different brokers, different ending times, starting times. So we all see it a bit differently. What could be a pin bar on one chart could be engulfing to the other, or could be still a slightly bullish candle on the next. So yeah, that's something that we can't avoid at the moment. So yeah, that's a bit funny maybe. So it depends, I guess. If you're looking to trade pin bars and looking only at pin bars, then certainly daily, weekly are more reliable. 4 hours is also good, but some confluence might be already an extra support. So with this pin bar, let's take a look. If we put a fib on here to here, we can see that that target is still open. Daily pin bar target, well, it depends. You could aim for the minus 272 target. We did have a 50 bounce, so it could have been the minus 272 target. I think it's a better target than minus 618 because minus 618 is just a tad above the daily resistance. That's something you want to think about too when aiming for targets, right? Also, the moving average is bearish. We had a pretty good fall, so you don't want to be too overly ambitious here with the target, unless you have reason to believe on a bigger time frame perhaps that this is the bouncing spot for a big euro odd rally. Well, then you might want to sacrifice some of that short-term profit, smaller profit, for the potential of a bigger run. In the euro odds case, I don't necessarily see that potential as yet. So from the euro point of view, we had a great daily candle, but we also had a weekly candle. So it's possible if you have risk management that allows it to even add a trade on the weekly chart here. And in this case, 38.2. That's the thing. Sometimes you don't get the 50. In this case, it would have been a loss. Right? That's also a bin bar here. This one would have been a win. This didn't have big enough wick. So best is to keep, of course, a track record of why you took the trade, which ones worked out, which ones didn't, why you think they worked out, why they didn't, and keep a scorecard of that. I mean, if you get, even if it's 50-50, but you get about anything from 1.5 to 2 units of reward for your risk, then you're still pushing forward. Alrighty, anyone else have a particular chart in mind for this pin bar strategy webinar? Fortunately, I didn't have many examples, but I thought the odd cat was a very nice one, though. Pound Swiss is not an example because the wick isn't big enough. But the Pound Swiss did have a very good one here, of course. It was a long time ago, though. On the hourly chart, it could be a good method to combine with fading the momentum. We had a webinar on fading the momentum about 2 weeks ago. And for instance, if you're in a strong downtrend and you have a zigzag against the trend, and the zigzag is approaching the minus 618 target, right? We have a 61.8 pounds, for instance, like this. We have a 61.8 pounds here, and we're heading towards the minus 61.8 target. And we have a bigger trend to the downside. Then waiting for a pin bar on the hourly chart at that target is a great confluence. That space, that spot makes sense for trading pin bars on the hourly. But we want to be careful not to trade pin bars at overly aggressive. For instance, this one here definitely wouldn't trade that pin bar. It meets all of the requirements I have for a pin bar, but still wouldn't trade it because it's an hourly chart and the impulse is down, plus the trend is down. Too many things lined up and stacked against it. So that's basically my pin bar story. If you have any questions, let me know still. Other than that, basically we can still take a look at the market together. The pound certainly pushed up a lot further than I expected. And I guess the positive, I mean, it was less than expected. The GDP, I think it was, right? The number 0.5, I mean, expected was 0.6, but still was positive. So I think the market reacted bullishly still. I mean, the news event itself, actually, we did see a 60-pip fall yesterday, but then we went up. I think because the number is still pretty good in like today's global settings, so it's actually, you know, decent numbers considering the other competitors there maybe, but or other countries. So, you know, in that regard, I think that's why the pound probably moved up that much. And kind of changed the characteristic at the moment. It now less important is this bearish momentum. More important is the actually bigger recovery after that. So, getting into certainly dropping that bearish mode at the moment. Now, knowing the pound, I wouldn't be surprised still to see a fall actually here. It likes, if anything, it does like to do the opposite of what you think. So now they created the bullish, the pound dollar created the bullish sentiment. We can probably see a downside still, at least to retrace part of that. Is that something I'm really jumping to trade, jumping for joy to trade? No, not really, to be honest. Not within FOMC close by. It's still a downtrend. The momentum is up, though. We certainly retraced higher than I ever expected, so I'm cautious on the pound dollar. Aussie still looks pretty bearish to me. I had a fib earlier this week on, I think this swing high, swing low. No, maybe this swing high, swing low. And looking for a turnaround at any of these fibs, maybe it was this one. I don't remember. Anyhow, if we get a bearish pin bar, excuse me, it could be interesting here at this spot. Dollar yen is in a triangle. The triangle could break to either direction, but if it does break, there's not a lot of potential before hitting resistance or hitting support. So I don't like much this particular triangle or contracting wedge. You could do it. I mean, it's definitely possible to take the break. I don't like the potential space. Doesn't mean, though, that the market will be capped by the resistance support that I think is important. It might not be. Also, even if you consider that support or resistance, it's still 90 pips up to resistance and about 90 pips down to support, so it's not that bad either. But the risk is going to be decent too if you use the bottom at least of, or the bottom or top of these zones. Pretty nice triangle though, pretty nice consolidation. One of the ones that are visually looking very nice in their build. What else? Let's see, AutoCAD. Here's an example of a candle with 50% of the wick, not quite meeting the pin bar requirement, but a reversal signal that totally failed. Price still pushed through. I mean, if we take a look at non-dollar pairs, perhaps that would make sense because of the fact that we have FOMC later today. Dollar could be quiet. Pound yen, actually, what else do we have regarding, besides the FOMC, do we have anything else? I forgot to take a look. No, we don't. No. Only lighter news still on the euro. Okay. Pound yen. Pretty messy charts at the moment. But obviously the bearish momentum is still lingering here. And the hourly looks a bit choppy. Looks like we're breaking, if anything, right? We're breaking a support like this. And we're trying to push through that support line. And there could be some fall here. Let's take a look at Camarilla. Maybe that would be better for this chart as well. Break below L3, we could see maybe a reversal on this 50-minute chart. Pound out had a pretty strong fall, so we could see maybe some zigzag correction. Let's see, Kaylin is asking about the Aussie 8060 or 8130. It's possible. The thing is with fibs is that we never know really how far within that fib they can go. Perhaps even above it. You know, we never know. Let's take a look at the daily for a second. For our looking at wave analysis, I think that we can conclude that probably the 38.2 or 50 is more likely. But ultimately, it is all about probability. It really could, in fact, be any of these fibs. But at this point, I would say this area right now, where price is at this moment, seems the more likely turning spot than the 78.6 fib. Big bullish candle, let's take a look. If there is any big bullish candle on the 4-hour chart, let's see. We already broke its high. So one thing, instead of taking the fib right here, we could wait for a candle, bearish candle. There are a couple of options. Putting the stop loss higher, but that's a pretty substantial stop loss. Or using like 15 pips above this candle high, or going above the 50 fib. Now we did have indeed a couple of bullish daily candles, but it seems, yeah, so that is something to consider. It depends on how today will end too. I mean, if a short is taken and today's candle ends up pretty bullish with a close near the high, then it could be good to get out of that short at hopefully break even or so, because then tomorrow's day could also have a push up to break today's high. If a short is taken and today's candle closes somewhere down in here, then you ended up taking a short at the top of the range of today's range, and today's candle closed pretty bearish. Then, of course, we have a pretty good chance of more downside tomorrow. That's how you could trade manage that trade, if you see what I mean. That's always a good tip. It's just, of course, there are certain bouncing spots within the day, and they could work good for entries. But if we then analyze that entry at the end of the day, then we see, of course, the entire sum of price action, and then we can conclude that although that entry spot made sense at that point, it didn't translate into the turnaround that we expected, and best is then to cut your trade short, most likely. An effective method of keeping your losses small. An effective method of trade management, I think. So keeping an eye on a 110 from higher candle itself can give a good idea whether the trade can go your way or not. So yes, we did have a bullish candle in the Aussie, therefore maybe being cautious with the shorts makes sense, but if we do get a bearish signal, then I would say that the overall structure trumps that particular bullish candle, and it looks like a good pin bar on the Aussie to me. A pin bar that I would consider worth trading. Of course, if one looks at the FMOC tonight, you might want to be more cautious with that and either use a bigger stop loss or not trade it. That's up to everyone themselves. All right, so that, I guess, is a good example of a potential pin bar around the corner. Let's see. If it is so, that also wraps up, I guess, our session for today. Let me show you. Nanette is going to take a look at advanced chart patterns tonight. Tomorrow, we together will take a look at exotic chart patterns, both at 5 p.m. GMT. So I hope to see you in both of these webinars, and I wish you all good trading and happy hunting. Cheers.